It's great to be back to my alma mater today. I was talking with Dr. Yeski this morning about when this great auditorium was built when I was a kid. I never would have dreamed that I've actually would have ever spoke here. I think the thought of that would have scared the crap out of me. And actually, I would say that it still does, so I'm going to do my best. I'm going to talk about sustainability today, and not the definition that you often hear about sustainability with greenhouse gas, but what I would say the most important definition of sustainability, which is really profitability in our industry. And it's been a tough run, right? I'm going to show you some data that shows that the industry's had a tough time over the last few years, and the outlook isn't even great, which it usually is when we have such a tough run. But I'm going to share with you there's a lot of companies that have done actually quite well as well, and my data will show that. And so I'm going to talk about some of the key differentiators about surviving as a business, and then I'm going to also reflect a little bit on my views on the industry and how we can not only really restore profitability and thrive again. So my agenda is I'm going to talk about both a producer perspective as well as an industry perspective. From a producer perspective, I'm going to just walk through sort of the P&L. I'm going to talk about revenue, cost of production, and some of the key drivers, as well as profitability. And again, I'm going to conclude with some of those key differentiators of thriving versus surviving or struggling over the past few years. And then I'm going to shift to industry perspective and talk about threats and challenges and opportunities. I also want to extend a thanks to Compere and MetaFarms and AgriStats, who have shared some really, I think, valuable information that I'm going to be able to share with you today. So first, let's talk about revenues in the top line. I got into this business, was a founder and CFO at Iowa Select Farms back in the early 90s. And in that time frame, the farm share, the red line, and the kind of the branded company / retail share of the retail dollar of what a consumer pays for pork were pretty equal. And the wholesale, by the way, is the pink line. That would be sort of the fresh packer cutout margin. And you can see over this time period that that's changed completely, right? The retailer has the largest share, and a lot of people get upset about that as producers. But the bottom line is they're consumer facing, right? They're thinking about the consumer every day. They're putting their brand out there, and as time has shown, we've lost as an industry in the production side the share of that retail dollar. I want to thank, by the way, Dr. Steve Meyer, who shared that piece of information with me. Talk a little bit, too, about our price discovery. I think how we pay for pigs, I think, is really broken and has been broken for as long as I was part of the business. And to digress a little bit, when I was with Iowa Select, we began building a modernized industry. And I was 30-something, didn't know what I didn't know, and we were out on Wall Street trying to raise money that ultimately helped build what now is Iowa Select and some of the modern industry. And I told these guys, the pork industry is going to consolidate just like the poultry industry. And I looked at ISU data that showed ISU producers were at about 13 PSY. We had our first farm, we were at 20. But I told everybody this was going to change. Over time, everybody's going to get up to 20, right? And now it's pushing 30. And this variability in the industry, just like in the poultry industry, just like every industry that consolidates, we're going to be a lot tighter in terms of our variability, and we're going to also be aligned and integrated, because that's what mature industries do. They work more together, they get consumer focused, and they align or they integrate. And interestingly, 30 years from now, I'm going to show you some data that shows that I would argue that variability is greater today than it was back in 1992 when we started Iowa Select. And one of the things that hasn't changed is price discovery. We continue to have this win-lose mentality of the packer trying to buy pigs for as little as they can, and of course the producer trying to maximize. And This is just a graph that shows three fairly typical pricing methodologies: one Western Corn Belt, one cutout, one lean hog based over a time period. And you can see the wide swings at times that are noted in arrows. In the first, over this total time period, the three are pretty close together, as well as in the 3-year time frame, the three are pretty close together. But over 5 years and the last 6 months, cutout is quite an advantage, and significantly, right? To sell the same hog on the same day for, you know, $10, $20, sometimes $30 a head difference just because of the pricing methodology, to me is madness, but we continue to do it. And that's part of why, when you look at this Compare database of trends and revenue, why again we've got this variability that I described earlier. You're going to see some other Compare data sets like this that show the average over time, the last 5 or so years, and then the top 25% and the lowest 25%. And you can see that I'm going to focus mostly on variability. You know, and to me this would be alarming if this was the top and bottom individual producer in the data set, but we're talking about 50% of the data set here, right? Top 25 and bottom 25 as I look at this data. And we're at $14 a hundred, or $30 a head different in terms of average revenue. So to maybe conclude on the revenue, some of the take-home points. The value capture, we all know this, right? It's closest to the customer. And what matters, the pork board's done a lot of great studies and surveying around what matters to consumers. It's price, it's taste, and nutrition. I think we got the first and third right. I'm not sure we've got the second one, and we'll talk a little bit more about that. You know, do we focus on output, throughput, price, or do we need to focus more on the customer? And I would submit that we need to do more of the latter. This win-lose mentality, is it sustainable? Well, it's sustained itself for 30 plus years that I've been in the industry, so maybe it is, but is it a recipe for success versus that alignment between producers and processors focusing on what the customers want and providing that to them? Price discovery matters. So again, it doesn't make sense to sell the same price on the same day for upwards of $30 a head different price. And I always thought, you know, our strategy at Iowa Select was alignment and not integration. We felt that being really good at production, live production, while we work with folks that were great in processing was a great strategy. I continue to think that it is, but in some cases it might be more effective than integration, but it really must be win-win. Shifting to cost of production, we see that same level of variability here. You're talking, you know, even a higher variability than on the revenue side, which again I said was $30 a head. So we're at $23 a hundred from that top to bottom 25%. So now we're talking $50 a head difference in the first quarter of this year, and a similar difference here for all of 23 in cost of production. I want to emphasize that in this data set, it's not the same companies for every data set for the 25 and bottom and 25. It's each data set itself is the top 25 or bottom 25 for what's being measured. The break even here on the top of just the operating cost, the typical operating cost, it brings into account the things like integration, things like other investments, you know, outside of the processor and outside of the production rather. And here, that actually widens that difference. So that difference again from top third to bottom third is $31 a hundred, or about $65 per head difference, which to me, every time I look at these numbers, it's staggering. So what's causing it? I would tell you that one of the major causes is difference in health, herd health and management. I don't need to tell most of these people in this room too that some of the trends are troubling in terms of health. With sow farms, this is MetaFarms data, about 1 million sows, 375 farms. We all know that this continues to be a challenge for our industry. Was really glad to see maybe a plateau that we came down some in the first quarter of 24. This is a history looking over about 10 years of litter size from total born to weaned. That gap back 10 years ago was about 3.2 pigs that we lose, and today it's 4. So that there's more pigs to start with, but it's about a 25% greater loss from total born to weaned than it was. This is nursery mortality. There again, I really think or hope that over the last couple of years it's plateaued on average, but you can see that the variability again against that bottom and 10, the bottom 10%, in this case it's 10% and top 10%, is very, very wide. Same thing with finishing, and again I'm hoping that we were on an upward trend kind of through 22. 23 came down some, which is promising, but that variability has just widened from top to bottom. Wean to finish overall, an increasing trend and increasing variability. It's interesting to note that this is all single stock wean to finish. This isn't combining the nursery and finishing phases, and the mortality loss is better than combining the nursery and finishing phases by almost 2%. And a piece of AgriStats data, these would be mostly larger US and Canadian producers. And this is 15 companies. This is actually on a flow basis as opposed to individual farms, so it's 31 flows. And you can see that the mean there for wean to finish is 2 to 3% higher than the MetaFarms data. And it's skewed pretty heavily to the right when you look at that bell-shaped curve, but huge variability then from 5 to about almost 16% in wean to finish mortality. Huge. You know how big of a driver this is, right? And all the costs you have invested in an animal that doesn't make it. Those variations create huge economic variations for sure. So when you think about cost of production, of course, feed cost is the biggest element, and that's been volatile. I kind of enjoyed Ross's rant, I'll call it, as he talked about all these dynamics, right, that in our crazy world today. And with fertilizer, energy costs, global conflict, the volatility of climate, our crazy policies of taking feed and using it for fuel here in the U.S. and biofuels. And there, I think, and I'm going to harp more on this later, but risk management is critical for the primary inputs like corn and soy meal. Also, the critical nature of formulation and best profit feeding is critical, and always seeking alternative ingredients. But other key costs have increased. For sure, I think even a later slide, I think I've got that feeds 2/3 of the cost of production. I don't think that's the case today. It was last year, where as corn and meal costs have come down considerably, but also as these other costs with inflation and post-COVID have increased. Really we've had some real challenges to our cost of production. That's also been a huge driver to the difficulties the industry has had. We all know, though, that the key cost of production driver is output, or I use the term throughput, is the denominator in that cost of production equation. Cost versus pounds. The other thing that we're really struggling with as an industry is asset obsolescence. And I'm not going to say directly, but we really do need to downsize an industry, and it's not. That's mostly because I think we have a lot of assets that really are just obsolete and really are not profitable. And as human nature and maybe farmer mentality, it's difficult to struggle actually maybe idling a set of assets. But I think objectively monitoring it, some companies have done really well with things like a functionality index to rank their facilities and really look and see if it makes sense to keep plowing money into assets or to even keep them operational. These strategies to shut down an operation are very difficult and emotional even, but they're important to our survivability and also oftentimes to improve health. I talk a lot about asset rationalization. Dr. Greiner mentioned that myself and my team do a lot of work with turnaround and working with producers sometimes when things are tough. And one of the first things that we do is look at individual production assets, and 9 times out of 10 we find assets that are losing money and really need to be shut down. It's a really simple thing to do and think about, but as an industry, we just don't do it. We're not good at doing it. If you look at a range of costs of production, we've seen upwards of $100 a head, if you could even fathom that, from best to worst within an operation. And you think about, you guys see this all the time, Walmart or Burger King, they may have a record quarter and they'll announce that they're going to close stores, right? They may be reinvesting in others, but so this is something as an industry we've not done well and certainly need to do. So some of my summary thoughts, there's a huge variability among producers in cost. So asset rationalization I think you need to do even when times are good, but certainly when times are bad. And again, health is really the biggest differentiator here. And I worry about even the sustainability broadly of our mortality trends. So we need to be vigilant about those things. I'm going to talk a little bit more about that from an industry perspective. And it really is a commodity business, so cost is king. So throughput is huge. I often, knowing that feed is our biggest cost too, I really learned when I moved from Iowa Select to more of the NutriQuest that it's really critical that nutritionists, whether they're paid, whether they're on staff or whether they're hired, are not really paid to take risks at all, right? They have no reward if things are improved, and really on the contrary, if they do something that's aggressive that might disrupt performance, they're going to get a butt chewing, right? So I always tell CEOs, have an open door and regular dialogue with your nutritionists. They're controlling such a big part of your purse string, and encourage them sometimes to take risks. Take risks with them because it's so important. And then lastly, I'd say cost is king, but as an industry, we've done an amazing job of investing in technologies and modernizing the industry and focusing on throughput. But today, is that really the recipe for success? We've got to really think about that and have the consumer more in mind. Lastly, just looking at just the profitability. So obviously those things lead to high variability in operating profit as well. So this is operating profit. The interesting things to note here is, first of all, the average producer during this period from 2018 to the first quarter of 24 lost money, and that's unprecedented. For as long as I've been in the industry, which is, I guess, 32 years, I've never seen a string like this. The bottom 25% have lost almost $9 a head over this time period. And but interestingly, the top 25% have only lost money one period over this year. That's 23. And again, I'm going to talk about those differentiators. We've hit on a few of those. And that range of variability has just continued to expand. So it was about 23 bucks back in 22, and it's now $48 a head difference in profits, net profit, from the top 25 to the bottom 25, which is almost hard to fathom. When you look at a smaller subset, I think the main thing I want to point out with this is that risk management is critical, and I'm gonna delve into that a little bit. You can see in almost all of these categories, if you're hedging, right? If you're forward buying or selling or hedging, typically when you're managing risk, an operating profit is going to be offset by a hedging loss, and vice versa. And so you can see that the hedging has typically mitigated, on average, the losses from operations, and in some case gone the other way. And I can tell you, for the top 25%, and I work with several, this is the difference. They're going to have black lines on all these periods, and it's going to be because they've managed risk. This is an excerpt too from Iowa State's own Lee Schultz, the manure value per market head sold, which is, of course, post-COVID, with anhydrous prices as high as they were, got up to $12 a head. They're now at $6 a head per market head sold, which is greater than average profits have been in raising pigs. So it's an interesting point to note. Integrated producers are gaining that value, and all of us should be focused on trying to gain that value where we can. So again, I'm going to dive in a little bit more into risk management, and I'll go back to the Ross rant, right? This age of volatility, all of these things that are attacking us, that many of which impact consumers and how they act. They impact how people trade internationally. They impact how much money is in the consumer's pocketbook. And there's also been this huge exacerbation of black swan events, and I list some of those here. All of this, which creates significant uncertainty and volatility. And I can tell you, I work with Joe Kearns at Iowa Select, and he's a good friend of mine. And I remember the days that we looked at hedging, and Joe did this for us at Iowa Select. We were proactive then, and it wasn't near as volatile as it is today. Now it's absolutely essential. And I also, in my work at NutriQuest, as we were developing international business, I've had the fortune of being able to travel internationally, and I can tell you that the U.S. futures market is absolute envy of the world. People in every other corner of the world would give anything to have this tool to be able to manage that volatility. And now with the USDA having the LRP and LGM as tools, that just adds another dimension to the tools that we have, which are just fantastic. And I would say a key separator of the strong, that top 25% from the rest of the pack, is disciplined risk management. Setting targets, having a target for ROI, looking at historical relationships, and typically, not always at the same exact time, sometimes staggered, but looking at a three-legged stool to take that margin that's derived from hogs, corn, and soybean meal and locking it in. Just a simple example of that, we put out this generic margin analysis, forward margin analysis every week. At the end of the presentation, I think I've got my contact information. If you're not getting it and are interested in it, feel free to flip me a note. But the bottom line on here, if you can see it, is about a profit. This was in April, of about $3. So this looks through all of the variables. This doesn't work up here, but all the variables we've got dozens of producers that we work as like a fractional CFO for, and we look at the cost of production, mostly Iowa, southern Minnesota, but also some eastern corn belt. We forward look at corn and soybean meal futures and look at the variabilities of cost and show what would forward margins look like today if you've kind of locked everything in, and it's by month. So each row is a month in the end, the margin per head by month, and the bottom number that I've circled would be, in theory, that if all your assumptions were right, if you on April the 5th locked in all of your pigs, you'd have a gross profit, that's before G&A and interest, of $3 a pig. Most of you guys look at these and have your own margin, so it's probably not something that you're familiar with. This next graph takes that $3 from all the years that we've been doing this and plots that bottom line number, right? That number that you could have locked in as a 12-month forward profit. And just very simply, but interestingly, in the last 3 springs of the year, in that March time frame, in the last 4 rather, had a producer been disciplined, looked for a target, maybe chose that target, they would have been able to lock in some really nice margins, you know, upwards of $25, $30 a head, you know, in that time period. So this is just illustrative, just to talk about, again, that tool. The other thing I would say that it's a key differentiator is just simply, you know, knowing and focusing on the numbers that matter, measuring and benchmarking. I mean, the consultant Peter Drucker said it well: if you don't measure it, you don't improve it. And the key tenets of that information is timeliness. It's got to be timely enough so you can react to it. We look at a lot of numbers that are in the rearview mirror. You know, a wean to finish closeout is a good example. Accuracy, right? The numbers got to be accurate, but also relevancy. Look at the things that really drive your operation, and don't get too far in the weeds. And to the relevancy, I would say, I would add to Peter's statement, if you don't measure it and set goals to measure against, you don't improve it. So I think benchmarking internally, setting your own goals, but as well as externally, to me is a great tool of producers that I think do well. So some of the take-homes from profitability. Again, key differentiators. You know, what are the differentiators from these companies that thrive and are doing well in this environment? You know, risk management, herd health management. You could argue those are certainly 1 and 2. I'm not sure if they're in the right order on this slide. They're both so key. Nutrition management, I would say a close 3. Pricing, I'd say I still look at that and say, really? I mean, that doesn't really make a lot of sense as an industry, but it's a differentiator. The value of data and analytics, as well as benchmarking and goal setting. Another, just aside, but are you able to capture the value of your manure if you look at that? I know for myself, I own a bunch of finishing barns, and kind of got lulled to sleep because I had a lot of them that when I built them, I gave permanent easements, which wasn't smart at the time for manure. But lo and behold, I discovered that in several of them, I had 10-year easements. So I'm in the process right now of talking to producers and just asking them to pay me a portion of the fertility value. Is there that opportunity maybe for some of you? And the other thing that's not in here, not measured, I don't have numbers or data to support this. Hopefully some of you do, if you do regular engagement surveys, is culture and employee engagement is a key differentiator. That probably goes without saying, and that's why I think it was great that Ross kicked us off this morning. Okay, I'm going to shift to industry here and try to get this quickly, looking at my watch here. This is a demography of the world population. So you've got age on the y-axis and numbers or percentages on the x, from 50 to 2100. And you can see that the population, that perfect pyramid, right, is what we want. We sort of had that around 1990, where birth rates are continue to increase, and you have that pyramid. By the way, I just on Tuesday celebrated my 103rd birthday of my mother's 103rd birthday. She's literally off the charts here, and she's off the charts, period. But But you can see what's happening is that we're losing that pyramid, right? It's getting much wider at the top, and when you look at individual major countries, you can really see what's happening. China, right, the largest population and the largest consumer of pork, from 1980 to 2020, you can see the huge difference in that shrinking with their one-child policy in the working class, and guess what? The consuming class is happening globally. Germany is the same, and Germany's pork industry, by the way, has shrunk considerably. We've had Stefan Suter talk to us about what's happening in their industry at a couple of conferences. Japan, that top block from ages 70 and up is double the population of again, the working and consuming class that we need to sustain. This is also the developed world without the U.S. in 2030. The U.S., thankfully, we're not perfect either, right? Ideally, you'd like to have that pyramid, but the U.S. is in better shape than much of the developed world. So this is going to be a big challenge for our industry, right? And one thing we got to recognize, so we've got baby boomer retirement. Guys like me, I love to eat pork, but I just eat less than I do, than I did 10 years ago. People, they invest less aggressively. Pork Board's done also some great survey work and are understanding that millennials and Gen Z actually eat quite a bit less pork than these boomers that are aging out. But as Ross said this morning, they're concerned about sustainability. So that, as I'll mention earlier, is I'll talk a little bit more later, is an opportunity, I think, for us. But globally, working and consuming classes are smaller. So with working age classes, that means labor availability and costs. Guys, Ross is right. It's difficult now. Well, it's going to get worse. There's going to be more competition for immigration, and obviously there's got to be more mechanization and automation. But the consuming class is getting smaller as well, and that's going to have an impact on demand. It's also having an impact on consumer preferences. We talked about this generation wanting to know how their food is produced, worried more about sustainability, and I should have added taste as being a big issue. And if I can't emphasize more about how health matters in these next 3 slides, we'll emphasize that. So this is Luke Gorski provided some data with me that compares the U.S. and Canada with Brazil, and then he didn't have enough. These guys are all in the AgriStats benchmarking program. These groups didn't have enough participants in Latin America in that data set to separate out like Argentina, Chile, Mexico. So he grouped those together. But I had a business in Brazil and talked to a lot of producers there. Right, they don't have PRRS there. Same with Chile. Right, health is the big driver here. And that even gets wider when you look at pounds of pork per marketed per year. That variance is even wider. And this, to me, is the scary thing. So with Latin America, we have such a great advantage in terms of grain costs here, that even though their productivity is higher, their costs are somewhat higher than ours, but not in Brazil. This is on a live hundredweight basis, and this is, again, these are just different databases of sort of top Brazilian producers that participate in AgriStats and U.S. and Canada. But again, if you don't think that solving this health thing matters from a standpoint of global competitiveness, then you're obviously wrong. And how can we do that? U.S. SHIP. Hopefully you guys are all aware of this. Tyler Hoke and others are leading an effort. I think we've got about 2/3 or more of you guys signed up. We need all of you, though. You know, this was modeled after the National Poultry Improvement Program. We've seen time and time again a foreign animal disease that the poultry guys have had with high-path AI, for example, and it's not been that disruptive to their exports. The best thing about this is if we get it in place sooner, Dr. Yeske and others will talk about the ability to use it not just in wartime, foreign animal disease, but in peacetime. We can use this tool to improve our lot in life as it relates to things like PRRS and PEDV. So take homes on the challenges front, again, this global demographics element and the shifting in demand and labor. We must take a more consumer-oriented approach, folks. We've got to do that in the U.S. And David Newman at Pork Board, I'm excited about the work that's being done to start recognizing that, and we need to do more of that. And we got to get engaged in that as producers. Global competition is tough. Brazil is formidable, as you can see, and disease is a huge element, as I've repeated over and over here. In terms of opportunity, to me, one huge one is sustainability. Remember, we talked about Gen Z. We talked about some of this group, that being more important to them. All public companies have to report on their gains in sustainability starting in 25. And you all know that most of our food retailers that are major customers of the industry have made pledges, zero carbon goals, et cetera. They're looking at us and they're looking at supply chain. And here's where the pork industry has a huge advantage. Doing more with less. We've done that amazingly as an industry. So again, I can't emphasize enough. I'm shocked. Now we have 2/3 or more signed up for SHIP. We have a lot less than that on this system, and it shocks me. I mean, if we want to get out of this thing and we got to focus on consumers, this is a key opportunity for us. The Pork Board's spent a lot of money, developed a terrific program to, on a farm basis, be able to be part of this database, which Pork Board then can share on behalf of the industry, but that you can share with your customers. And if you look at some of the dynamics, this is the report, it boils things down. For example, in this particular farm, who was a neighbor of Ross Bernstein that he mentioned before, 4,228 passenger cars off the road per year based on the management practices that they have for sustainability. It's a great program. I can't emphasize enough how we all need to jump on the bandwagon there. Another opportunity, global supply dynamics are shrinking. We talked about the EU especially, but also in China. The price in China is coming up, meaning that their supply has come down. And the growth prospects aren't there, right? I don't think with labor availability, with the capital costs that we have and other costs and risk, I think global supply, and I think also in the U.S., is going to shrink before it grows. So in terms of key take-homes and for industry opportunities, we need to overcome and manage these challenges. And I know Dr. Yeske is chairing a PDV elimination task force. Those are some of the many things that I think are critical for our competitiveness. SHIP and getting involved in SHIP, I think, is great. Our sustainability story, again, sign up if you haven't done this already. And I think just as an industry, this is the big one we've got to figure out. Pork Board is focused on it. A lot of people, myself and others, are working on trying to change the mindset some about this consumer orientation and taste within our industry. So the title slide had the word growth in it. I think we need to grow, right? We need to grow by improving and doing these things that we've talked about. We don't need to grow in terms of size, and I don't know who in their right mind today would think differently than that. And lastly, I think the individual, I'm sorry, it was Jason that teed this, this day up for us, I thought did a great job of talking about resilience. And if there's anything that I've learned in my 32 years in the pig industry, it's that this industry is strong, passionate, and resilient. We have this passion for excellence. We have engaged stakeholders and trade organizations. We're very entrepreneurial in embracing change, especially technological change. We need to be ready to embrace global demographic change. We need to be ready to shift our focus to consumer from efficiency driven. Both are critical. Efficiency driven is going to continue to be important for sure, but if that drives every decision that we make, I think we may have challenges with demand. For individual producer businesses, you know, we've got to have an environment to attract passionate talent, have that culture of excellence and care of not just pigs but people. We really need to have logical versus emotional decision making, right? That as it relates to risk management, as it relates to things like asset rationalization and dealing with asset obsolescence, and as well as disciplined health and biosecurity measurement, you know, locations of sites and best practices, and of course getting on board with SHIP. And then also this consumer focus and this on-farm sustainability program. Feeling overwhelmed, I get it. But I always say we do really well as an industry though when our hair's on fire. If I had any hair, I guess I could resemble that more, but I'm so confident that we can and we will do this as an industry, and there's no question that we'll emerge stronger from these challenges. So I don't know, Laura, if we have time for any questions or not, or.
We have time for about one question, but you're going to have to come down kind of low so we can see and hear you if anybody has a quick question for Steve. Otherwise, well, we can give him a round of applause while we're waiting for any questions. Let's start there. Is there a question? I think they're all still thinking, Steve.
Yeah, a lot to think about, a lot of information, but thanks a lot for your attention, you guys. Have a great day. Thanks.
Yes, thank you, Steve.